So I think one of the main themes that's emerging is that distress in the banking sector is a much more important driver of business cycles than we may have realized. People before the crisis, before 2008, tended to sort of divide recessions into sort of financial crisis recessions, like what happened in the Great Depression and in 2008, and also then non-financial recessions, the rest of recessions. And they're driven by other causes, like oil price shocks in the 70s, or the monetary policy, or trade shocks. But I think what we're realizing is that there's often a component of overlending, which leads to distress in the banking sector, and that this is often not just an amplifier of recessions. Before, something else would set off the recession, but then this would lead to losses in the banking sector because people would start to default on loans, and this would amplify the recession. So that's definitely true. But now we also sort of see distress in the banking sector as maybe a trigger of many business cycles. It's the shock in the banking sector that leads to the start of the recession, that sort of sets off the recession. I'm Matt Barron from Cornell University. I'm an assistant professor of finance at the Johnson Graduate School of Management at Cornell. I teach MBA classes related to investment management and behavioral finance, and my research interests are in the fields of banking and financial crises. I do a lot of work on the history of financial crises, and the more I dig into this, the more I realize that there's a lot we don't know about historical financial crises. There have been a lot of classic works by Reinhardt and Rogoff, by Bordo. There's a long tradition of studying historical financial crises. While there's sort of foundational works in our fields, there are some issues with how this work was done. I mean, one thing you realize if you line up all the previous chronologies of past financial crises is that sometimes they don't even agree on when financial crises happen. They disagree on sort of the basic fact of the incidence of financial crises. Because these previous chronologies are mainly based on narratives, based on stories, we also don't have a sense sometimes of which crises were major crises versus minor crises. And as things sort of recede into the past, the history gets blurry. And when you go back to the 19th century, it's sort of often difficult to really understand the causes of financial crises just based on narrative approaches. So one thing I do in my work is I uncover new historical sources that allow a more data-driven approaches of financial crises in an array of countries, not just the countries we usually study like the US and the UK, but also emerging markets back in the 19th century, countries like Argentina, Brazil, Chile, and gathering data on stock prices, bond prices, bank balance sheets, new archival sources. By going back into the archives, we have a much more clear and detailed picture of how a lot of historical banking crises evolved. So there's a lot we've learned through recent research about the causes of historical banking crises. One of the key features from recent research is credit booms. It used to be thought that banking crises were just caused by depositor runs. Depositors got scared, they ran to the bank, and it was a self-fulfilling panic. And that's certainly a part of it, this liquidity aspect of banking crises. But now we realize that most of the major banking crises of the past were caused by large bank lending booms. Usually the economy is pretty good to start out. There's reason to be optimistic, but it gets a little carried away. House prices start to go up. There starts to be a real estate bubble, a construction boom. A lot of this is funded by debt. Then the banks start lending more against the real estate. This pushes prices up. And at some point, this real estate bubble collapses, as it does in 2008. This is sort of a historical regularity. So the study of historical financial crises has tried to understand both how a lot of historical crises are the same, what are the recurring patterns, maybe different ways that we could sort of prevent these bubbles from getting started in the first place, but also a lot of recent research has realized how heterogeneous these crises are. Some crises have a lot of fraud, other crises have, are sort of more international in scope. So it's important to sort of realize both what are the recurring features, but also how historical crises have been different, and to sort of take away the key lessons for policy today. So one thing we're interested in our research now is what we call quiet banking crises. This is the idea that some banking crises can be caused by big lending booms, bank lending booms, where there's excessive bank lending. This fuels a real estate bubble. But when it collapses, you don't see the sorts of panics and depositor runs that you see in other crises. This might happen, for example, because of a government that backstops the financial sector. It gives not just sort of deposit insurance, but also complete implicit guarantees to creditors, maybe because banks are too big to fail. But can you still have a banking crisis and a sort there, because these banks that made a lot of bad loans, they're taking a lot of losses. These banks can be deeply undercapitalized. They could stop lending, this could lead to a credit crunch, and it could also have severe ripple effects on the macroeconomy, even if we don't see the sort of panics or runs that we did in 2008. And our research suggests that these crises can be bad too. Maybe a good example is the Japanese financial crisis in the early 90s. Everyone believed that the government would backstop the banks, so there weren't overt panics, at least not for the first 7 years of that crisis. But yet, the banks stopped lending and the economy sort of slowed to a halt. We study that historically to understand whether such a situation might arise, say, in China today, where there's been a lot of over-lending, where there's been a real estate boom, and this debt boom is starting to slow down, and this might again have ripple effects on the macroeconomy. It could lead to slow growth, even if there's not an overt banking panic. So I've also studied the role of too big to fail. When a bank is so big that it's widely expected that the government can't let it fail. A lot of thinking suggests that this is in general a bad thing, and I agree, because it leads to moral hazard. If a bank knows that it has a government backstop, it's going to lend sort of in riskier ways, which could lead to a more likely failure in the first place. But during a financial crisis, there actually might be there might be a silver lining. I'm not saying we should create too big to fail banks, but there is, if you look historically, there's certain financial stability benefits that might arise. One thing is just that if there are a few major banks, it's very easy for the government to know how to regulate them. I always think about the Great Depression in the US, where thousands of banks failed. In some ways, the problem might have been too many to fail. If there are too many small banks, they could just fall like dominoes. If there are a few big banks, and I think people often bring up the example of Canada now, where there's like the big four or the big five, it's very easy for the government to know which 4 or 5 entities to really strongly regulate and to watch. And so there might be some reasons to sort of study or emulate some elements of the Canadian model, where a few big banks that are sort of strongly regulated by the government. One thing that's becoming clear in recent research is really the interconnectedness between the banking sector and financial markets. And I think to a lot of market participants, this is sort of obvious. When there's a problem on Wall Street, obviously this affects stock markets and bond markets and has ripple effects around the globe in financial markets. But a lot of traditional models in economics and asset pricing actually sort of treat the banking sector as what we call a veil, it doesn't really matter. What really matters is, in the end, is fundamentals. And I would agree with that too, but we realize now how much distress in the banking sector when there's a banking crisis or banking losses. This leads the banking sector to sort of withdraw credit. And a lot of leveraged investors, you could think about hedge funds or investors trading on margin, they have less credit to buy assets with, and this could lead to fire sales, it could push down prices. So credit cycles, when the bank is sort of extending credit or later retracting credit, this has ripple effects into asset markets, and this may be one of the main drivers of asset price fluctuations in stocks and bonds. And so this leads to sort of a new way of thinking about business cycles, where the banking sector and the macroeconomy are sort of much more connected, even during so-called normal recessions, non-financial recessions, than many people thought before.